So historical cost and its relevance to inventory system. The principle states that all stock needs to be recorded at the price at which we paid, or the historical cost of that asset. So basically a practical example of this is that if we go to a supplier and we want to buy goods to the value of 10,000 Rand, and that supplier has now offered us a cash discount of 10% on that value of stock, this means that we will only be paying a price of 9,000 Rand for that stock, which according to historical cost principle, we have to record that stock at the price at which we paid. So it'll be the 9,000 Rand is the price at which we paid for the goods, which is the price at which we need to record in our books. Okay, so now if we look at prudence and its relevance to inventory systems, prudence just states that we need to be conservative when recording our value of our assets, okay? So with inventory systems, stock can sometimes lose its value. It is realistic, and when stock loses value, we have to record that loss in our trading stock, because now our trading stock isn't worth what we said it's worth. So with that, valuators come into our business and they'll give us a net realizable value of our stock, so what the market value is of our stock, and we will always record the value of that stock that's in our store at the lower of its cost, or the net realizable value that these valuators came to tell us what it actually is. So we need to always record that loss that we made, so what we actually recorded it as, and the change in the cost. So we would decrease our trading stock with the amount that we lost, and we'll now create a new expense account to put the loss into, so that will become like a trading stock loss account. So now if we look at faithful representation and its relevance to inventory systems, remember faithful representation just states that our financial statements need to be free from error, they need to be complete, and they need to be neutral. Okay, so this is what the relevance to it is, that we got to make sure that the statements are neutral, so it's not favoring any stakeholders within the company. So the valuation methods that the business chooses cannot favor the net profit at the end of the day. We cannot choose one value because it's going to increase our net profits, which means that the owner is going to walk away with more money in his pocket at the end of the day. So we just need to realize the link that we can make to the faithful representation of the profit at the end of the day and how we got to that profit. So the valuation method is important. It needs to be appropriate to the business that we're running and the type of stock that we sell. Remember that.